There have been some wild swings in the financial markets recently. Of course, SVB, everybody's concerned, is my bank next? I'm going to show you some details right now that expand upon this and highlight what's really been going on. You came here for the truth, so let me unveil that for you. I wanted to show you this first, and we're going to talk about the credit default swaps and so on. But right here, apparently the suggestion is that a single CDS, that's credit default swaps, trade may have caused Deutsche Bank's recent crash. In the US, the downfall of SVB resulted in a massive $16 billion bailout for one bank paid for by taxpayers. And in fact, I was going to include that in this video, but I'm going to do an entire video about how you paid for the bailout. And that happens each and every time. But this is just one example. Let's dig in, shall we? Let's begin with this one, looking at the CDS of all these different companies, Goldman Sachs and Morgan Stanley and so on. Credit default swaps are basically a bet or insurance, if you want to think of it like this, against the risk of a company. Like how risky a company is, you'll start to see these CDSs climb up. And we saw that they did, and of course for banks like Deutsche Bank and others that were exposed to a lot of this, theirs went up like crazy. That has come down quite a bit. So the market believes that the risk has started to wear off. That's what I'm showing you right here. A lot of these banks, not even just the small banks, the big banks, they're exposed. They've done the same thing. The difference is they have a lot of liquidity. They also have a lot of guarantees. A single bet on Deutsche Bank's credit default swaps is seen behind Friday's rout. This was, of course, before, but I just wanted to show you that one bet. Now, how could that possibly be? Well, you could see a roughly £5 million euro trade had been fueled the set off. And let me show you this. There are markets like the single name CDS market, which is pretty opaque and very shallow and very liquid. With a few $1 million, you can move the CDS spreads. And it just shows us that it doesn't take much to create a crisis. So if there was something intentional going on, whether it's somebody trying to just profit off that scenario or this is about something bigger, it shows us that it doesn't really take much weight behind it. A few $1 million could suddenly create panic in a company, and that would affect everybody. Because if too many of the deposits started leaving, too many of the investors started leaving, it presents a problem for liquidity. And so that's why it's important for companies to have a lot of liquidity. They need to have things that maybe on paper say, hey, you could be making a lot more return from what you have here. But at the same time, you don't have a rainy day fund. And that goes for you as well. You as an individual, you might say, just for instance, and we have an inflationary period right now, but if you had a lot of cash in the bank, you could say, well, I would rather have that in the stock market because, hey, I could be making a return on my money. That's fine. That makes a lot of sense. But what if stock market suddenly drops by 50% tomorrow? And you need that liquidity because somebody in your family's sick, because of something that happened economically, you lost your job, whatever. Well, your stock just came down by 50%. Do you feel that it would be good to sell? Well, no, I don't want to sell because it came by 50. I want to wait till it gets back up. Well, now you got a problem. And that's why they say cash on the sidelines. That's why it's important to have a rainy day fund. And that goes for anything. And people just ignore that all the time because they are always pedal to the metal. If I do this, I can achieve more. But it's very worrisome because when you run into a crisis, you end up getting punched in the face. That kind of hurts. Now, there's more to this. There's more to share. Financial markets right now, they're looking what we see with whole risk of recession rising. The same time, the stock market has actually been performing really well, if you think about it. Experts are speculating that the Fed's first rate cut may be coming soon. In fact, they believe it will be coming in the middle of this year. Also, it's wise to prepare for stagflation given current market trends. The growth may not be there. You could see that coming out with earnings. And it shows us And I've got some charts to show you. I've got some information here. Profit sentiment worsens. Analysts keep cutting earnings estimates for corporate America. This has an impact. You might not care. I'm not invested in that. But ultimately what happens is when these companies don't have those earnings coming through, they fire people. If the layoffs happen, you have a domino effect and so on, okay? Fed normally cuts after the 3-month, 30-year curve starts to steepen. So what does this mean? Well, essentially that when we have the yield curve inversion taking place, what is a yield curve inversion? I've talked about this many, many times, but essentially what that is, and think about it, if you're buying a 3-month piece of paper versus a 30-year piece of paper, debt, right? If you're gonna buy that, wouldn't you think that the 30-year would give you a better return than the 3-month? You're taking more of a risk. You're holding for a longer period of time. Well, that reverses yield curve inversion. And that makes a big issue for a lot of people, of course, but it signals a recession. So we get that. That's happening right now. All the yield curves have inverted, but when it comes back up, that's really the actual signal. Not when it's going down, when it's coming back up. And we're getting that right here. And so the Federal Reserve, as they say in this case, Fed has on average started cutting rates 6 to 8 weeks after it bottoms. This one here, particularly with the 3-month and the 30-year, potentially bottomed 2 weeks ago after SVB. So we got to look at where it is and so on and see how they all react to it. But the expectation is very soon we're going to get the cuts. The cuts come, inflation goes up. Okay, look at it like that. As an individual, you want to know what the takeaway is. When they cut interest rates, inflation goes up. The dollar, the value of the US dollar can decline. Now, if every other currency out there does the exact same thing, the US dollar can maintain relative strength. So we only know what others are doing. The Fed has normally cut rates before now. And so we see that. Mean CPI year over year, looking at this, I mean, it's pretty clear. You could just see it. Inflation this cycle peaked 9 months ago. And then you compare that with the Fed cuts on average 6 months after the CPI peak. So anyway, what the market is pricing in right now is middle of this year. I can tell you that. I've seen the charts. I've shown you in previous videos. That's the expectation. So we have these meetings coming up in the summer. And so we're going to see if the Federal Reserve does in fact cut at that point. They can do an emergency meeting at any point and simply cut rates. But we got to pay attention to that when they've told us over and over and over and over again, we're not going to cut, we're not going to cut. You know, here it is. We'll see. We'll see if that's really true. I'm not so sure. Velocity collapses negative for stocks. You could look at it. This is just comparing the US stock market versus the M1, okay, real M1 year over year. So we can see if the money supply has been growing or shrinking. And of course, you look at money growth should keep falling as bank crisis tighten conditions. And we don't know what's going to happen. They want to expand the monetary supply. And of course, the balance sheet itself has expanded because of all these new lending programs that they have introduced. And only time will tell if they'll keep doing that. They had a very minimal quantitative tightening in the previous week. And I'll give you details about the newest one when that comes out. We'll get that on Thursday. So stay tuned to the channel, hit subscribe so I can bring you the details of what the Federal Reserve is about to do. Are you interested in that? All right. Now, don't forget about living paycheck to paycheck, because I've shown you these stats before and you can probably tell me you know people that live paycheck to paycheck all the time. It is an absolute matter of fact that most people, no matter what amount of money they make, they live paycheck to paycheck. I'll show you the stats. Here it is. Look at this. 62% of Americans are living paycheck to paycheck. Does that surprise anybody? Really though? I mean, why? Why is that the case? Because inflation's so high, because they don't have maybe the financial education that they need. They're not watching Money GPS and they're struggling. So we see that just in this example. I've shown you so many surveys like this: 62%, 63%, 71%, 82%, 59%. Doesn't matter. The majority of people paycheck to paycheck. I've shown you examples 100,000 plus, 200,000 plus, and so on. Everybody does it because they want to keep up with the Kardashians. And then we had this, Canada doing it again. Congratulations, Canada. You see it right here. They want to do a few things, including the alternative minimum tax, changes to it. They want to expand that. We're making sure that the very wealthy and our biggest corporations pay their fair share of taxes so we can afford to keep taxes low for middle-class families and invest in our healthcare system and social safety net. What I can tell you is that they absolutely will not be lowering taxes for individuals in the middle class or anybody else. They will only increase taxes because this is the game that they play. They are always increasing, and they do so not to actually help people, but to impoverish the majority of people. And when you start looking into and understanding why the taxation system exists, it's to take money away from the many and give it to the few. And until you realize that, you will not understand how this all works. You have to look into this. If you would like more details about it, I know it aggravates a lot of people that are very much, they really love what the government structure does. If you look at it, it is very clear. It's there. The more information than we will ever need is all there. Let me ask you something. Are you an insider? If you become an insider, I'll email you directly the video of the day so that we can get around the algorithms, and I'll be able to get that to you. It's right here, themoneygps.com, or go to themoneygps.com, scroll down to the bottom, fill in your email address, and I could send you the video directly. I'll see you there. Take care.